Another dimension of audit reporting, which I always say is quite easy to understand, is the types of reports auditors issue. Okay. So by the names of the report, you should be able to understand what the report stands for. So we're looking at types of audit reporting or auditor reporting, yeah. And then we finish up with the reporting. So what are we going to, so the report of auditors to shareholders, specifically, let me put it that way. So we want to look at the form and content of the auditor's report, the Bannerman wording. You know, the Bannerman wording, I'll say it in passing. Now, what is meant by a modified report, and explain how modified reports are worded, and the possible effects of a modified report on the company, and the purpose of an emphasis of matter report, the consequences of issuing an audit report, knowing it to be false. There could be consequences. Okay. Let's see. In terms of auditing, the question is, whom do we report to? Shareholders. Shareholders. So there is a difference between internal and external audit responsibilities. Internal audit will report to management. External audit reports are normally to shareholders. The purpose of these audit reports is to provide assurance to the addressees of the report. And it's also communicating the nature of any problems we've identified during the course of audits. We would also actually give you an actual or potential effects of these problems, and then convince management that action is required. And of course, provide practical ways to overcome problems. One thing which is not here, which I want to highlight, is the management letter. The management letter. Normally, auditors will write this letter and give it to management, those charged with governance of the company. Shareholders ideally should have access to this report, but I can tell you for a fact, most shareholders express no interest in these management letters. Now, this management letter doesn't normally come out to the public. People don't see it. We call it the letter of weaknesses. It typically highlights the weaknesses within the system, the causes of those identified weaknesses, the effects on the company's operations, the causes of these weaknesses, any criteria, reporting criteria it might have violated. And then we can also talk of practical recommendations on how to solve these issues. So we don't normally see them in the public domain. They are very serious reports which are written, and if it comes out, it could cause troubles. Okay. Well, external auditors per the company's Act 206 will report to members, shareholders. For public sector reports, the statutory reporting responsibilities are defined by the relevant statute. And external auditors will carry out assurance assignments which are not defined by statute, and for which they receive separate written instructions. So we sometimes do that as well. In addition to the statutory audit, we can also carry out specific assurance assignments. Now, expression of opinion. The auditor's report requires that they express a clear written opinion on the financial statements taken as a whole, based on the auditor's conclusions drawn from specific audit of evidence obtained. Now, for the purpose of reporting, auditors would need to be independent of the members of the company shareholders and of the company directors and of the company itself, so that they can express a free and fair view. Now, the decision, auditors have to decide whether they have gathered sufficient appropriate audit evidence to support the opinion they're expressing. And they must have reasonable, not absolute, reasonable assurance that the financial statements are free from material error or misstatement. Reasonable because we don't do everything. We don't review everything. Okay, we deal with some sampling. Of course, there are some situations where auditors will review everything, especially items which are few, transactions which are few. There are some transactions, even if they are many, but the material amount involved or the nature of the transactions, you review everything. Directors' remuneration. Okay, for example. They also have to consider whether the content of the financial statement is fairly presented. and conforms with relevant statute or ICES. And they have to also consider whether uncorrected errors are material or not. And what do we do? So these are some of the key considerations that they consider. Key considerations they consider. Key factors they consider prior to arriving at or drawing out their conclusions. Okay. The financial statement adequately refer to and describe the relevant financial reporting framework. The financial statement adequately disclose the significant accounting policies selected and applied. The accounting policies selected and applied are consistent with the financial reporting framework and they are appropriate. Accounting estimates are reasonable. Information presented in the financial statement is reliable, relevant, comparable, understandable. The qualitative characteristics of financial information. The financial statement provide adequate disclosures to enable intended users to understand the effect of material transactions and events on the information conveyed in the financial statement. The terminology used in the financial statement, including the title of each financial statement, is appropriate. So these are considerations that they normally would want to consider. Review the accounting policies, FRS 18. So you check final accounts for whether they comply with statutes, with regulations, whether we've disclosed sufficiently, and whether they have been consistently disclosed and our policies have been consistently applied over the period. And then perform a final analytical review, just as you perform the initial planning analytics. Do a final planning analytics. Final analytics, not planning, okay? So as you've done a final initial planning analytics, you do a final analytical review for consistency. Now, ISA 450 deals with the finalization procedures, and here we want to evaluate any misstatement identified during the audit. Is it factual? If it's factual, it could be mistake of fact, okay? Is it judgmental based on inappropriate accounting policies and estimates made? Or is it projected? We've made mistakes projecting into population from our sample. We made a mistake in the sample, so clearly it will be projected into the population. All right. Now, in finalizing these and considering the misstatements, any uncorrected misstatement must be clearly flagged out. Review any nature and reasons for any misstatements and bring them out. And any uncorrected misstatements, we will always set our audit materiality thresholds. Are they approaching the threshold or are they exceeding it? Do they require adjustments? If management won't change the material misstatement, and then they have to give us a written representation to explain why they think they will not change it. If it makes sense, we can rely on it, but of course, we want to dig deep and be sure why they want to stick to their stance. Now, auditors will write to directors requesting material misstatements to be adjusted. Any material misstatement will require it to be adjusted. Key audit matters, you would have heard CAM. So CAM applies to listed companies, public interest companies, unlisted PIEs, and other entities which are required, and those which choose to report on how they have complied with the corporate governance code. Now, it does not apply where the auditor disclaims an opinion. So when we want to modify or issue an adverse or unqualified, yeah, it applies. But where we say we don't want to give any opinion, then CAM doesn't apply. For CAM, in accordance with ISA 701, auditors are required to report on this and include any reference regarding the levels of materiality and performance materiality. The performance materiality is a bit lower than the higher materiality threshold, okay? Now, they must explain to the reader what materiality is, why materiality is important, and how materiality differs from performance materiality. So they must show for each category how they've estimated materiality, performance materiality for the financial statement, of course, provide an explanation of the significant judgments made by the auditor in determining these estimates. Now, content of an audit report, a lot. And as an auditor or as a student of auditing, you must always know this. The title is there. You will see an example in the appendices. The addressee to whose consumption the report is designed, what has been audited, which financial reporting framework was used to prepare the accounts, the opinion paragraph, and then the reason why we are giving such an opinion, and then conclusions relating to going concern. Okay, we're also looking at opinion on other matters required by the Companies Act, like content of directors' reports, matters on which auditors required to report by exception, like a negative assurance, okay, a limited assurance, statement of directors and auditors' responsibilities, the date we sign off, and the auditor's signature and auditor's address must all be stated there. You would have heard of the Bannerman wording under auditor liability, simply saying, like it's stated there. What they are saying is that, listen, we have done this audit solely for the members of the company in accordance with Chapter 3, Part 16 of the Companies Act. That's what we've done our audit. Now, we have been very cautious to the extent that if you decide to rely on this report, you do it at your own risk. So what they are saying is that to those to whom this is addressed, we give this report. If you are not an addressee, and if you are someone we do not know that you rely on this report, and you do rely on this report, we will not accept or assume any responsibility whatsoever if you suffer any loss as a result of relying on this report. I would advise you to go and look at the Royal Bank of Scotland and then Bannerman, where Bannerman did an audit of a client, and knowing that the client is has a loan covenant with Royal Bank of Scotland, and yet didn't do some good job and was taken to court. Since then, auditors will always put a clause in their report to indemnify themselves from any future liabilities. Modified or qualified audit opinions. They are telling you that there's something wrong with the report. It's not 100% clean. Okay. So there are two bases here: pervasive material, but not pervasive. Now, where the problem or the misstatement in the account or in the audit findings is pervasive, it means it is significant in terms of an understanding of the account, that the auditor either cannot express an opinion or will refuse to express an opinion. When we say pervasive, it cuts across a good number of areas, okay? But when we say material but not pervasive, it means it is a big amount affecting one or few aspects of the account, but not every aspect. Okay, so the auditor will express limited opinion. Okay, now whenever it is pervasive, material and pervasive, there's a trouble. There's a trouble. But where it is material but not pervasive, we can always end up modifying the report. Okay, so typically this is what we have. If you limit my scope of work, you don't give me information, you don't respond to my queries as an auditor, you restrict me from taking stock or to observe the stock counts, you don't give me the information, you limit my scope of work. If it is pervasive and it cuts across a number of areas, there's trouble. There's trouble. But if it is material but not pervasive, we can exempt that area. So, well, except for the matters shown in the inventory reporting, the rest gives a good and fair view. But while it is so pervasive, it cuts across, and I'm not able to do my work well, I disclaim my opinion. I'll tell you that because I was not given the opportunity to do A, B, and C, and I couldn't get access to A, B, and C, and I was limited, I cannot express an opinion. because I wasn't allowed to do my work well. Okay. Now, where there are disagreements between the auditor and the client, and accounts are materially misstated. If it is materially misstated and pervasive, I give an adverse opinion that the accounts do not reflect a true and fair view. Material and pervasive. Because materially, we are disagreeing on items which are material in nature, pass across a good number of areas. Adverse opinion. But if we are disagreeing, it is material but not pervasive, we can say, well, except for the item of PPE, where we think that we disagree with the management's management take on XYZ factors, the rest gives a true and fair view. That's it. All right, good. Then there is an emphasis of matter where there are uncertainties which may be outside the control of the organization. And again, it could be purely like a legal outcome or a case outside the control. What do we do as an auditor? We create a paragraph called emphasis of matter paragraph. And then we emphasize it. It will not lead to qualification of the account. We simply want to draw attention to a matter which is suitably reported in the financial statement. It is not a modification. If matter is not properly disclosed, then we will qualify it. But if you come out clean and give us information, we'll emphasize the matter, we will not qualify the account. All right, so from this part onwards, I'll leave you to take a look at it. These are content of an audit report. These are examples. Director's report and strategic review, director's remuneration and report. You could pause the video and study this, okay? This is a typical example of a wording of an auditor audit report, the title, the addresses, there's the opinion paragraph and basis. Okay, that's it. Then these are also examples, still continuation of the audit report. All right, so I'm gonna end here and take your time, study this, go for the text. Any other good auditing book will have samples of these audit reports. Okay, you can also even Google, or you can just go for any auditor reports of any known company and you will see a typical scenario given here. So these are the key audit matters, audit reports. Okay, so this is what I explained, and then audit. So that's it. And then there are some very good examples here you would want to review and check and attempt them just to have a very fair understanding of how these things work. All right. So that is it for the reporting dimensions, and I wish you all the best in your study. Bye for now.